Hey, what's up, traders? It's Victor from TRADEPRO Academy, and I hope everyone's doing extremely well. In today's video, we have another options video for you guys, and what we're going to be talking about is somewhat of an interesting topic, right? It's a very discussed topic, I would say. It's controversial, maybe some might think, but we're going to be talking about 0 days to expiry options, zero DTEs. We're going to be talking about lottos, right? They're called lottos in the options community, and we're going to be talking about how to actually trade them successfully, what we have seen in the past, what we've seen through options communities versus how we would suggest, honestly, taking a look at them. Now, they've gained a lot of notoriety over the past few years, these 0 DTEs, as we call them, lottos, because they are lottery trades, right? They're pure gambles, and that is probably why they had a bad rep, because people are pretty much just taking money and throwing it at the market and kind of seeing what happens, kind of like a lottery gamble. Now, throughout this video, we're going to be breaking down exactly what a lotto is. We're going to be talking about how a lot of options communities actually do trade them. And we're going to also be talking about how we prefer to trade them and some successful outlets that you might want to consider when you're trading 0 days to expiration. Now, generally speaking, lotto trades are taken 0 days to expiry, right? The option actually expires that same day, and you're expecting somewhat of a massive move in the underlying asset that you're trading. Now, the issue with that is it's usually a gamble, right? It's very hard to kind of predict this massive move. That does allow you to gain a lot of percent value, dollar value. Now, the point of these is you're taking these very cheap options, you're throwing some money at it, you're taking profits that you may have earned throughout the week and hoping to make the best of them, or maybe that you haven't earned any profits throughout the week and you're really hoping to turn this around. Whatever the case may be, we're going to be talking about why that's maybe not the best of ideas and how you could possibly do it successfully in the options day trading world. So with that being said, I want you guys to stick around because it's going to be very informative. And I also want to see in the comments down below, do you guys trade option lottos? Do you trade 0 days to expiry? Let me know, and let me know what kind of success you've had with those and what kind of successes you've seen others have with them. Now, with that being said, I want you to smash that like button, hit that subscribe button, and wait for this intro because we're going to be deep diving into this. Lotto trades are usually taken on Fridays because generally stocks do expire with their options on Fridays, right? We have those 0 days to expiration, which are usually going to be on Fridays, right? They do happen every month as well, but more liquid stocks, they do happen on Fridays. These options trades are taken on Fridays, and you're expecting a pretty large move in the underlying, and you're throwing money at these far out the money options that are worth maybe $1, maybe less, and you're combining a few hundred, maybe $1,000, a few $1,000s into a trade that you're hoping that explodes in value in one way or another. And the thing with this is you do need a very large move, because when you're trading 0 days to expire, you have Greeks that are working against you, such as potentially IV, but the main one is called theta. Theta is a time decay Greek that does burn the value of the option based on the timing that you have. So if you have very limited time, that value of the premium drops very quickly, especially into the end of the day. And if you're trading out the money options, it's going to hit even harder. Now, even though this does seem very fun to gamble away, especially in the options world, this has been the case over the last few years when options did explode in popularity amongst the recent crashes and rallies we've had, rallies mainly thanks to the Fed, but it does seem very counterproductive because we want to be in this game for a long time, want to be able to earn profits consistently, and Lotto Fridays seem like more of a fun activity rather than a productive activity. Now, you're looking for a very extended move to gain a lot of profit, and realistically, there's a lot of stocks out there. So traders and communities are going to siphon through a bunch of stocks, seeing which ones can move the most, right? Even with smaller, minute moves, you can get 50, 30, 40%, 100% in a stock, but you have to be in and out very quickly. Now, keep in mind, you're risking pretty much the whole premium to see some kind of move. So when you get into the options trade itself, you're pretty much saying, you know what, this money's probably gone and I'm going to take profit when I take profit. So there is a huge gambling portion of this, rather more so than skill, right? You're pretty much just throwing money at something and expecting it to move. Now, there's a lot of problems with these, and let's explain those. Number one, you're going to be siphoning through a lot of stocks, 10s to 50s to 100s. It doesn't matter. You're going to be siphoning through a lot of stocks to find something that potentially moves. The other issue with that is it might not even move, right? You don't know that it's going to move. Maybe there's some kind of news event. Maybe it's already moved pre-market. Maybe you find something that actually does have a news event that day, which is fine, right? You can get a pretty decent move off that. But realistically, it's not the highest probability you're going to get this very extended move, especially on a Friday. You also need a move. You desperately need a move. Otherwise, those premiums are gone instantaneously. Remember time decay and theta. Now, in slower markets like we've been seeing in 2022, and also probably going to be continuously going because, again, there's money flowing out of the market and money supply, you're not necessarily getting those extended moves, and you're not getting a lot of volatility and movement in the market unless you have some kind of news event. Now, there's also the option to do these 0 days to expiration with SPY and Triple Q because they have recently come out with expirations that do happen every day. You also have that possibility with the SPX. Now, we'll talk a little more about that as well because those key ETFs are very, very important. Now, the thing with these ETFs is they don't move as much as individual stocks, right? Especially those ones because they're tied to a greater basket of individual names and they haven't seen that much volatility unless you have news events like the Fed. So we have talked about what could go wrong with 0 days to expiration, what could go wrong with these lottos, but there's also a correct way to do it. And we want to talk about the successful way because there are a lot of traders that do it successfully out there to trade these 0 days to expiration. Now, there are some that do find these big winners and these very, very large movers, which it is possible, right? But there's also other ways to do it. Now, the main thing that I want to focus on is that we've established that theta is a huge component in burning the premium of these options. Now, if you're burning premium on an option, that's on the buy side. If you are an options buyer, whether you're buying puts or calls, you're burning the premium realistically if the price does not move on a 0 day to expiration. So logically, if we think about this, there's two sides to the option. Let's not forget that, right? Those two sides to the option, one is going to be the buy side, the other one's going to be the sell side. Now, if the buy side is continuously burning this premium and theta decay is working against the buy side, well, logically, doesn't it make sense that if you're on the sell side of things and you're actually a part of that theta burn, that it would make a little more sense to be on the winning side of this 0 day to expiration? So that brings us into a different step. What if instead we were writing calls and puts instead of buying calls and puts on these 0 days to expiration? Now, we can, instead of buy, we can open a short position in terms of a credit. We can turn a complete naked put or call, which I don't necessarily advise, but we can have a day trade credit, which allows us to be net short the position of the option, capping our risk to actually collect that premium. Now, granted, right, you're not going to be seeing these massive 100, 2, 3, 4, 5,000% gainers. However, you do have a high probability of actually burning the premium down. So you collect 100% of that premium, right? If you're writing options for $1,000, $2,000 on credits, right, and you collect that money, it's a more logical way to trade the 0 days to expiration because a lot of people are expecting theta decay and those options to expire worthless, especially if they're super out the money. And two, you're playing on two ends here. When you're directional, right, you want the price to actually move in your direction. If I'm long Tesla calls on a 0 day to expiration, right, and it's trading at $800 and it's trading at $150 and I have this 200 call, even if I have 170 call, I need this thing to swing higher, right? However, if I'm trading on Tesla, right, and I know that, you know what, it's looking pretty bullish. However, I don't know what the speed of this bull is going to be. I don't know if the speed of this bull is going to be crazy. I don't know if it's going to be a big move, but I do know that it's probably going to look a little bullish. Now, I can cancel out because there's three options. I can cancel one of the options out. The three options when it comes to options are options is a directional move, right, for you, a directional move against you, and a flat line, right? The flat line meaning it doesn't really move anywhere. Now, if I'm doing credits and I'm actually collecting premium and selling, what I'm doing is I'm capturing the potential of a flat line and I'm capturing the potential of a directional move. So the only thing that I don't need to happen is for the price to actually run against me. So even if it flat lines, I'm going to collect the premium. Even if it runs away from me and in my direction, I'm going to collect the premium. So what I've done is I've increased my probability and I've cut out one of the possible three things. So now I have two things going for me instead of one out of those three. So again, for example, if we use Tesla or SPX, right? Well, let's use both of these options. We have Tesla at 150 and all of a sudden it starts running and I'm expecting a move to the upside, right? Maybe I expect to go to 160, maybe 155, and I don't know how it's going to get there. Now, if I buy the options, a 0 day to expiration, let's say I buy the 170s and it does move up like 5-10 points, but it does that throughout the whole day. Now, the thing with that is theta can burn and the speed at which it moves could be so slow that I actually might not get any profit at all. Now, instead, let's say I sell a credit spread on Tesla and I say, you know what, it's not going to go below 140. And then I cap that risk with a 135 put. So I'm selling the 140 put. I'm collecting, let's say, $2 of premium, and I'm buying the 135 put. I'm paying $1 in premium. My net premium gain that I take home is going to be $1. Now I sell 10, 15, 20 of these, and I'm collecting $1,000 to $2,000. Now all I need to know is that Tesla is not going to be below 140 by the end of the day, right? That's it. Now, if I'm expecting this move up, even if it goes from 150 to 155 in 4 hours, the calls are probably going to lose value because there's 0 days to expiration. It's going to be slow. However, my puts that I sold are going to give me that premium. Same thing with SPX. If SPX is at 3,800 and I know it's not going to go below 3,800, I can just sell some puts and then buy some lower puts and collect that premium. But how do we go about this? How can we break this down a little more? A lot of people have the option to sell naked puts, right? Now, when you sell naked puts or naked calls, what you're doing is you're just selling an options position and you're collecting the whole premium. However, your risk is very, very vast. You, one, need a lot of margin in your account, because when you're selling to collect premium, you're going to need margin regardless, right? There's a difference between needing a lot of margin and not as much margin. If you're selling naked puts or naked calls, you're pretty much saying that if this goes beyond my naked put or naked call, my losses could be very, very large and potentially infinite. So we don't necessarily want to do that. A lot of people do that. They'll do it very, very far away. And if they have the account balance and the margin to do so, that's fine. However, if we want to do this on a 0 day expiration, right, and I want to protect myself, right, let's say I'm doing the SPX, because when you're doing 0 days to expiration, you have the ETF, so you can do this on a daily basis and collect premium on a daily basis, right? I would prefer to do it on ETF, right, or an index rather than an individual stock, because they do move a little slower realistically. Let's take the SPX as an example. If I think the SPX is somewhat bullish to flat on the day, what I'm going to be doing is selling puts on this asset. Now, what I mean by that is, let's say 380, right? 3,800 is going to be the baseline. I don't expect prices to go below that area. What I'm going to do is I'm going to sell those 3,800 puts on the SPX, and I'm going to buy the 3,780, right? It's going to be a 20-point difference. Now we have to understand what the margin looks like on that. A 20-point difference, right, is going to be a $2,000 margin requirement, right? A 10-point difference is going to be a $1,000 requirement, right? But the thing is, if I'm selling the 3,800s, for example, and I'm collecting $2, and I sell the 3,780s and I have to pay $1, right, I'm going to collect $1 net, right? Or $100 per contract. Now, if I sell higher and I decrease my margin is only $1,000 in this case, I'm probably going to be collecting less premium. Instead of $1, I'm going to be collecting 50 cents, for example, a contract. So you have to keep that in mind and understand what your margin risk is and also what the premium you collect is. Does it make sense? Is it worth it? Now, to do this, ideally, when you're selling these credits, you want to have high IV. You want to see things that have a high implied volatility, because that will spike the price of the contracts. And it's great because, especially on 0 days to expiration, if there's no movement, that IV spike is going to get decreased very drastically, and you're going to collect the premium much, much faster. So you can check the IV, you can check what a normal IV is and see if there's IV spikes anywhere that look very interesting for you to sell these areas. And again, technical analysis is a huge proponent of this. If we analyze on a technical basis what some key resistance and supports are, I don't expect prices to go above or below these areas. That makes for a good area for me to start selling some of these credits, right? Now, generally speaking, when we're talking about this, ideally, I want to be collecting a net credit of between $1 and $2, at least $1, right, to make it worth it. And I don't necessarily want to have a margin risk of over $2,000 per contract. Now, this doesn't, you might think, well, okay, if my margin risk is about $2,000 and I'm collecting $100 of premium, does it really make that much sense? Well, you're looking at the probabilities, right? What's the probability of this happening? Now, also, you can close these positions before they expire, right? That's the great thing about American options. What you're doing with these is you're actually closing out the position, right? Obviously, you're not going to get assigned. American, European, you can close them anytime, but you're not going to get assigned. But the point being is you can close them out, right? You have 40, 50%, 30% gain. You can close these out, no problem, and collect that premium. Just be done with it. You can wait until the end of the day to collect the majority of the premium. If it moves against the credit that you have, even better, because then you can collect the premium much faster throughout the day. But the point being is $1 to $2, that's the premium that I'm looking to collect. Anything above that, that's great. But again, you have to take into account the margin risk. So with that being said, right, you can use your technical analysis, find some areas. I'm going to post some of the trades that we were talking about in terms of credit spreads that we do on a daily basis in our room. And I'm going to show you guys some examples. Today, for example, right, we had a massive expectation for the downside through some key levels, right? We found some market maker positioning. And I said, you know what? Well, I doubt that this price is going to be above 38.85 into the end of the day, right? That's the credit that I chose to sell. And then I bought a call above that, and I'm looking for somewhat of that downside move. Now I'm collecting about $1 in premium, and I'm expecting this thing to go down. Now, conversely, if I had 0 days to expiration, which I did on the SPX, right, which were puts, the puts almost did 400%. However, those puts went to -50, -60% before they made that massive move. And what I'm doing with this is I'm collecting the premium from the credit, and I'm putting only half of that into that 0 day to expiration. So it's a combination between this, and we do this every day here at TRADEPRO Academy. So I'm going to post this chart up. You can see what my analysis was on the SPX, right? You can see where we started off, what I'm expecting to see as a high point. I don't expect price to go above that area. And you can see in Discord here that we have placed those orders and our ideas in that channel, and that's how we do that combination. Now, if you want to learn more about credits and honestly trading 0 days to expiration with more of a premium sell strategy, come check us out at tradeproacademy.com and let us know down below. Have you been doing credits? Have you been collecting premium on 0 days? I'd like to know, because that seems like a more effective way to trade these lotto trades. Even though there is the potential to have these massive gains, I want to be a little more confident and strategic in the way that I do it. So remember, hit that subscribe button, hit that like button, and we'll see you guys next time here at TRADEPRO Academy on YouTube. Take care. And check us out, community.tradeproacademy.com. And down below, we do have some free resources for you guys. If you like futures or options, we got some stuff for you. And I'll see you guys next time.